Inflation is the big risk to investors, says Walker Todd, a former Fed official and a research fellow at the American Institute for Economic Research. Up next, he recommends ways for investors to protect their portfolios.
A lot of your thinking recently has been about deflation and in particular inflation. Please help us understand why the bulk of the people are currently worried about deflation, and yet you are taking the position that inflation is in fact the greater risk.
The Fed has increased the balance sheet from around $850 billion a year and a half ago to around $2.2 trillion today. That's roughly 2.5 times expansion of the balance sheet. And the bulk of that expansion occurred just since Labor Day of 2008. It was still around $900 billion going into Labor Day of 2008. So, to my knowledge, this is the first time since World War II that any industrial economy, except for maybe Hungary, has tried to expand its money that much in a single calendar quarter. But traditional monetarist theory teaches that with a lag, it can be anywhere from 6 months to 18 months typically, that money creation will catch up to you observed by the public in the form of a rising price level. Anna Schwartz is still alive. She was Milton Friedman's co-author on the monetary history of the United States back in the 60s. And she and I co-wrote an article that was published in the journal International Finance. The date is summer of 2008. We had to turn in the article in August of 2008, just before the great expansion of the Fed's balance sheet began. But we were complaining then about what the Fed was doing, what it had announced it was going to do, and we made the observation that if they do this great expansion that is contemplated through the discount window instead of through open market operations, they will have a great deal of difficulty tightening again when the time to tighten comes.
Okay.
And that's where we are today, that they've thrown it out there, lots of money has been created, and there's no easily visible exit strategy.
Walker, in the end, we're all trying to look out after our own interests, and specifically how to position our portfolios with these incredible risks that are out there at the moment. What would you recommend if we take your scenario of inflation being the greater risk? What should people be putting in their portfolio to hedge against that risk?
You should assume government misbehavior and then fix your portfolio accordingly.
Right. So what should we be doing?
Right. And reasonable recommendations would be, and these are essentially just traditional inflation hedges. You want to buy some gold in some form.
Let me stop you there.
Yeah.
There's been a lot of reports that gold is great as a crisis, coming out that this is a crisis commodity, but it's actually not that good as an inflationary hedge. The recent studies have been indicating. That is, when there is a political crisis or 9/11 type situation, that is the commodity. But long-term inflationary pressures, it is not. The returns are actually not that good. Do you prescribe to that, or?
I can see the argument against buying gold if you were, say, in 1991 and you were looking to 10 years of reasonable expansion,
right,
a slow rate of growth of inflation at only a moderate pace. Gold is not going to do much for you in that environment.
Right.
But we're not in that environment. I just told you we doubled the money supply in a single calendar quarter.
Right.
That is a crisis, and you need some hedge or protection against that.